For years, people were told that UK property prices only move in one direction, up. But what happens when that story suddenly starts to break down? The latest housing data is sending a clear warning signal across Britain. According to Halifax, UK house prices have now fallen for 3 consecutive months. In March 2026, prices dropped 0.5%. In April, they fell another 0.1%, and in May, prices declined by a further 0.1%. The average UK home price has now slipped to 298k. What's even more surprising is that many analysts expected prices to rise in May. Instead, the market moved into opposite direction. That suggests buyer demand may be weakening faster than economists anticipated. Annual house price growth has now slowed to just 0.5%. That's roughly half the growth rate many experts had forecast. Behind the slowdown is a growing affordability problem. Average 2-year fixed mortgage rates have climbed from 4.83% in March to 5.66% today. For many buyers, that means hundreds of pounds in additional monthly costs. As borrowing becomes more expensive, fewer people can afford to enter the market. At the same time, economic uncertainty continues to weigh on consumer confidence. Many potential buyers are delaying purchases. Others are waiting to see whether prices will fall further before making a move. And this isn't just one lender sounding the alarm. Reports from Reuters and analysis from Capital Economics suggest the UK housing market is clearly losing momentum. Some experts now believe prices could face additional downward pressure if mortgage rates remain elevated throughout the year. The question is no longer whether the market is slowing, the question is how far the slowdown could go. Could this be a temporary dip before another recovery? Or are we witnessing the early stages of a much larger correction in the UK housing market? Stay with me, because the latest data may reveal where UK property prices are heading next. Before we talk about recent 3-month decline, we need to zoom out, because when you look at the last 19 years of UK housing data, every different story emerges. Let's go back to 2006. The average UK home cost around £177,000. At the time, the market was booming, credit was cheap, mortgages were easy to obtain. Many people believed house prices would continue rising indefinitely. Then came 2007, average prices climbed to roughly 185k. Confidence remained high, but beneath the surface, financial risks were building. In 2008, the global financial crisis hit. The UK housing market experienced one of its sharpest slowdowns in modern history. Prices fell back towards 175k as banks tightened lending and buyers disappeared. By 2009, the average property was worth around 165k. Thousands of homeowners saw the value of their properties decline. It was the first major reality check for the market in decades. Recovery began in 2010. Average prices rose back to approximately 170k. In 2011, values edged higher to around 172. By 2012, prices reached roughly 174. Growth remained slow. The housing market was still recovering from the financial crisis. The momentum returned. In 2013, average prices climbed to around 180k. In 2014, they jumped to approximately 190k. Government support schemes and low interest rates helped fuel demand. In 2015, average prices crossed 197k. By 2016, they exceeded £203,000 for the first time. Despite uncertainty surrounding Brexit, house prices continued rising. In 2017, the average home was worth around £210,000. In 2011, roughly £214,000. In 2019, about £215,000. Then came the pandemic. Many expected property prices to crash in 2020. Instead, the opposite happened. Record low interest rates, changing lifestyle preferences and government support created a housing boom. Average prices surged to approximately £223,000 in 2020. By 2021, they had exploded to roughly £244k. In 2022, the market reached one of the strongest periods in the history. The average UK home climbed to around £267k. Compared with 2009, price had increased by more than 100k. But the era of ultra-cheap money was ending. In 2023, higher interest rates began cooling demand. Average prices eased slightly to around £260k. In 2024, the market stabilized nearly £265,000. Buyers became more cautious as mortgage costs remained elevated. By 2025, average UK house price were sitting close to £270,000 according to official government data. Think about that for a moment. In less than 2 decades, the average UK home increased from roughly 177k to around 270k. That's an increase of more than 50%. Today, after years of relentless growth, we are seeing something that hasn't happened often in recent years. House prices have now fallen for 3 consecutive months. The question is whether this is simply a pause in a long-term upward trend or the beginning of a much deeper shift in the UK housing market. Now let's step into a purely hypothetical scenario, not a forecast, not a prediction, but a stress test of what could happen under extreme condition. Imagine that in 2027 the UK is suddenly removed from IMF special drawing rights SDR basket. This move triggers a major loss of international confidence. Global investors begin to reassess the stability of the British pound. In this scenario, the immediate reaction would not be gradual. It would be sharp, fast, and driven by sentiment. Foreign capital starts leaving UK assets. Demand for sterling drops on global FX markets. The pound begins to weaken significantly against major currencies like the US dollar and the euro. Let's break down what that would mean for the housing market. UK property prices are normally measured in pound sterling, but international investors think in global currency terms, especially USD and euro. So even if UK house prices stayed flat in pounds, their value in dollars or euros would fall immediately if the pound collapses. Example: FX shock impact. If the pound were to fall by 20% against the dollar, then a 300,000 British pounds UK home would effectively drop to 360k in dollars, equivalent from $450,000. If the pound fell by 40%, the same property could be worth only $270,000 equivalent. That's not a change in the physical house, that's repricing of UK wealth on the global stage. But the more important effect would likely be domestic. A weaker currency usually leads to higher import prices, rising inflation, reduced real wage, higher interest rates, pressure from central banks, and that combination tends to hit housing hard. Second order effects on UK property. Mortgage rates could rise again as lenders price in currency risk. Domestic buyers would face reduced affordability in real terms. Foreign investors might pull back entirely from UK real estate. Liquidity in the housing market could dry up. Historically, when currencies lose value sharply, housing markets don't just adjust in FX terms, they often reprice domestically as well. That means UK prices in pounds could also fall, not just in dollar conversion. Potential outcome range in this extreme scenario: in a mild shock, property values might fall 10, 20, 30% in real terms. In severe currency crisis, declines of 30, 50 or even 60 in foreign currency terms would be mathematically possible. In a full confidence crisis, domestic price drops could compound the FX effect. But it's important to be clear, this is not a baseline forecast. It is a stress scenario based on extreme macroeconomics assumptions. But in reality, in 2027, British pound could be forced to leave SDR as Chinese yuan, euro and dollar is getting bigger and the British pound is losing. So actually 2027 is realistic term for British pound to leave SDR. It will be forced to leave. Real world housing markets are influenced by many stabilizers: central bank intervention, monetary policy adjustments, fiscal support, structural demand for housing in the UK. Still, it highlights one key truth: housing is not just local, it is deeply tied to global currency confidence, and if that confidence even breaks, the impact is felt far beyond mortgage rates or monthly payments. It is felt in the value of wealth itself. Now let's combine these stress factors into one scenario, not as a prediction but as a way to understand how fragile the system can become under pressure. Imagine three things happen at the same time in the UK. The Bank of England raises interest rates by 2 percentage points. UK house prices fall by 30%, a large share of homeowners fall into negative equity. Mortgage rates in the UK are extremely sensitive to base rate changes. A 2% increase can dramatically reshape monthly costs. Example, 250k mortgage over 25 years at 4% interest rate equals to £1,320 per month. If rates rise to 6%, monthly payment rises to roughly £1,600 or £1,650 a month. That's an increase of around £300 per month or £3,600 per year. For households already stretched by inflation, this becomes critical. A 30% drop in property values is not just a paper loss, it directly affects households' balance sheets. Example, 300k home drops to 210,000 British pounds, 250,000 home drops to 175k. But mortgages don't adjust downward automatically, the debt stays the same. But what is negative equity effect actually? Example, you owe 240k, your home is now worth 200k, you are 40k underwater. This creates a powerful financial constraint. You cannot easily sell, you cannot refinance, you are locked into the property. Remortgage is not accessible. Important clarification: falling house price do not reduce monthly mortgage payments for existing fixed rate borrowers. So homeowners face a double pressure: higher interest rates, higher payments, falling property values, no wealth buffer. In this scenario hits at scale, several chain reactions usually appear. Consumer spending drops, more income goes to mortgage payments, housing transactions freeze, sellers refuse to accept losses, buyers wait for further price drops, refinancing, remortgage crisis risk. People cannot move to cheaper loans due to negative equity, bank caution increases, lending standards tighten, first-time buyers get pushed out. Once homeowners see their property fall below their mortgage value, confidence drops sharply, spending becomes defensive, long-term financial decisions get delayed. This is where housing cycles often become self-reinforcing. Fear reduces demand, lower demand pressures prices further. A 2% rate shock alone is painful, a 30% price drop alone is severe, but together they create a system where monthly payments rise, households' wealth falls, mobility freezes, financial stress compounds, and the most dangerous part is this: negative equity doesn't just reduce wealth, it reduces options.